Hello again. We're here to continue the series of conversations at the Moravian Archives that we've been having over the last 6 months. With me is Diane Shaw. She is the president of the board and chair of the Planned Giving Committee. We've been engaged in a dialogue about how people could best support the archives to continue building the financial foundation for the archives for future generations. Today's conversation is going to be about tax disadvantaged assets that you may want to consider as gifts to the archives if you are philanthropically motivated. I guess I should start with a disclaimer. We are not attorneys or CPAs or financial advisors, but we care about the archives and we want to make sure that you have information that you can take to your professional advisors, be they your estate attorney, your tax advisor, your financial advisor, to discuss what is best in your circumstances to accomplish your goals.
Steve, we appreciate having you with us for these conversations. The archives, receives a number of outright gifts, but we're wondering if there are more efficient ways for people to give to the archive.
Sure. So by outright gifts, I'm assuming you mean people are writing checks out of their checkbook, right, or that kind of thing. One of I think the second most popular gift is a gift of appreciated securities. So this is a stock you bought for $10, it's worth $100 now. And if you sell it, you're going to have a capital gain tax on the $90 of gain. But if you give that stock to the archives or another charity, you will get an income tax deduction based on the $100 value. Currently, you will not have to pay the capital gain tax. So basically, your gift is costing you less than it would if you were just writing a check for $100 because you're never recognizing the gain or paying the tax. So that's I would say the second most popular way people support charities that are important to them. And it's as easy as directing your broker to transfer electronically your shares from your account to the archives account. There are people, my father was one of them, who still had the paper certificates until we convinced him it was really time to put them into safekeeping in terms of getting them into an electronic account. But you can transfer paper ones as well, and we can discuss that if you have questions. If you call the archives, we can walk you through that. So that's the first. And the second is really the tax-deferred retirement plans, Diane. This is as another employee, longtime employee with a college or university. Tax-deferred retirement plans have become really the primary retirement for many Americans. And as we put money voluntarily into these funds, or our employers match it or put in an amount, these frequently become our single largest asset beyond our real estate, our home. And at the end of life, these are some of the most heavily taxed because we put the money away tax deferred. We never paid income tax. So it's subject to income tax and estate tax if we're in an estate taxable level. And in 2025, the very significant threshold that is in place currently in 2024 is due to sunset and come down. So many more people may find themselves in a taxable situation. I don't have a crystal ball to know what's going to happen with the tax policy. I don't think the people in Washington do either. So these assets become a great vehicle for supporting charitable causes. You can do it during your lifetime. Once you reach age 70 and a half, you can direct up to $100,000 from an IRA to charity in a given year. And that 100,000 is cumulative. So the archives is one of 2, 3, 5 charities that's important to you. The total of your distributions, which are called qualified charitable distributions, QCDs, if you're someone into lingo, and those transfer without any recognition of that income. It doesn't get added to your adjusted gross income, so it's not affecting your Medicare or your Social Security taxation. So it's a real bonus. And then, of course, at your passing, you can direct a portion of your retirement plan assets to the charities that are important to you, and they will get 100 cents on the dollar. There is no income tax or estate tax to be paid on those. I would say, and maybe I'm jumping the gun, go ahead. Cautionary notes. It's important to split your retirement plan assets between what you want to go to charity and what is for your loved ones, because the tax law as it stands now and the Secure 2.0 Act has shortened the time with which individuals can take the money out of an inherited retirement plan, and it's now 10 years. But if it's commingled with charitable gifts, that can be shrunk even further. And so I would never want somebody to be caught. Again, this isn't tax advice or estate planning advice, but I do encourage you to speak with your own professional advisors and make sure that they fully understand both what your wishes are and get that put into writing, both on the beneficiary designation form, but into your other planning documents that you're leaving for your family.
Steve, how do people go about directing these retirement plan assets to the Moravian Archive?
Sure. So one, I would recommend, if you're viewing this and interested in exploring that, to reach out to Paul or to Diane at the archives to walk through what is needed in terms of the tax ID for the Moravian Archives, the official name of the organization, address, all of that information if you don't have it. And also to reach out to your plan administrator, because each plan typically has its own form, and you want to be using their form to do this. And it's going to be a little different whether you're asking for the qualified charitable distribution to be made or whether you're talking about beneficiary designation at the termination of your life. The QCD parts, some fund managers now are distributing checkbooks. So you may have a checkbook for your IRA that's intended for you to write a check to yourself. You can write a check directly to the Moravian Archives. Just make sure that it is dated by December 31st and postmarked, because that's the IRS requirement. It's supposed to be out of your account. So I would not cut it too closely. I would say make December 1st your deadline if you're doing it during your lifetime. And you know, at age 73 now, under the Secure Act, you are required to take a minimum distribution from the collective retirement funds that you have. And so it can be a significant chunk of change. And if you've discovered you have enough income anyway, receiving more that you don't want is going to push you into a higher tax bracket. And this can become another pot from which you do your charitable giving, not your personal checkbook and not your stock account, because the stock account actually is a great thing to leave to your living heirs because they will get a step up in basis at your passing. And it's basically like giving them cash. If they wanted to liquidate it, they could. If your favorite stock is a company that's near and dear to your family, they can hold on to it for sentimental reason. I know that was a case in my family. My mom held on to the GE and the AT&T stock that she had inherited from her parents. So these are some of the specifics. It's, again, always important to talk with your professional advisors, your financial advisor, and make sure that these ideas fit within the realm of what you want to do for your living heirs, what you need for you and your surviving spouse, if you have one, and what you want to accomplish on the charitable side.
Steve, I know you have spoken from time to time about unintended consequences. What would you caution our viewers about?
Sure. So one consequence is this acceleration of distribution from a retirement plan. You don't want that to happen. Also, if you have a stock that has lost value, that is not something to give to charity. That you should liquidate yourself if you want to divest of it. Take the loss as a tax deduction and give the proceeds to charity, because you lose the benefit of that loss. If you give it to charity, you can't claim that. Other unintended consequences, and this is kind of outside the philanthropy conversation. If your spouse passes, if a child passes and you have them named as a beneficiary, if you get divorced, you need to update your beneficiary designation forms, whether it's these retirement plans we're talking about, or life insurance, bank accounts. Because what happens is if you don't do that, those institutions are required by law to follow the beneficiary designation form. It does not flow it back into your estate. It will go to whomever is named, and it may be somebody who's deceased, and they will have to reopen the estate to then distribute those funds. So like changing the battery in your smoke detector, it's really worth once a year sitting down and looking at all your beneficiary designations and making sure that they're up to date.
Very good advice, very good advice. Well, we're really glad to know about all of this, and we hope that this has been helpful to you all out there. Again, we do encourage you to speak with your financial counselors and your other professional advisors before making any decisions. But we do look forward to being able to work with you on giving to the archives if that's something that you desire. Steve, we really appreciate your joining us for this series. And please check out the other topics online and learn how to plan effectively for tomorrow.
Thank you for being with us. It's been a pleasure.